Welcome to our monthly video post. In this video post, we are going to be talking about the nuances and challenges of small cap investing. I have with me Mr. Arunagiri, Chief Investment Officer of Trustline. Without much ado, let me dive straight into a few interesting questions. Welcome, Arun.
Thank you.
Trustline is into small cap investing for 17 plus years now, and small cap investing is Trustline's forte. My first question is, what is your view on small cap investing, a broad view?
Thank you, Govind. Thanks for this opportunity. As you rightly said, yes, Trustline is only into this small cap investing for last 17 plus years, and we have not done anything else but small cap investing. At Trustline, the story starts and ends with value investing, that too in small cap investing. That's well said. Coming to your question, there are two ways to approach small cap investing. One way is to take a very conventional approach, look at it as a very risky space and avoid it altogether. When you do that, of course, you are also saying no to the huge delta and alpha returns from small caps. But the other approach is to take a slightly contrarian approach, but a very objective approach. Contrarian, but at the same time very objective. That is, take the pain to understand all the risk in small cap investing and build a process to mitigate and avoid those risks. That's much more demanding, much more painful, but it's a lot more rewarding in the long term. As the game in small cap is all about weeding bad apples. That's why, small cap investing is an exciting thing for any investor. That's my broad view, Govind, on small cap investing.
Thank you, Arun, for that question. Well answered to that question. The second question of mine is one question that would be in the investors' minds. Very common question is that why should you reckon small caps when large caps are well researched, have a high institutional participation, are less volatile, and the quality ones can give decent returns over the long term? Given this, why should anyone go through the challenges and the risks associated with small caps?
Absolutely, Govind. I think this is very interesting because you're right. Large caps are much safer, less volatile, much more covered by brokerages and institutions, a lot of institutional participation. And anything you want to get, any information, you can get it at the click of a button. So it's so easy to do research in large caps, then you can make a decent returns. But small caps, as you said, it's a lot more risky. You've got to do a lot of due diligence. But this is, why small caps are very interesting is because of the fact that it can give you a lot more compounding effect. This is where the secret of power of compounding comes into play. So a well-constructed large cap portfolio, let's take it as an example. At best, it can deliver 14 to 15% annualized returns, right? At the same time, a well-constructed, high-quality small cap portfolio can deliver close to about 20 and north of 20% plus. So there's a lot of difference. It may look very simple. The 5 percentage points in an annual return may look very simple, but when you do it over a longer period, it gives you an exponential value creation. So for example, if somebody is annualized returns in large cap quality portfolio is about 15%, it means it doubles in every 5 years. Which means over a period of 25 years, you are looking at a 32 times kind of return. Same thing in a high quality small cap, well-constructed portfolio. If you're doing about north of 20%, then you are looking at every 4 years doubling your value, which means over a period of 25 years, you are looking at north of 75 times, very approximate numbers, but 75 times plus, which means over 24 years, a 1 crore investment can go to 32 crores in large caps, whereas it can go to more than 75 plus in small caps. That's a very exponential value. If you extend the horizon much longer, then the value creation can really, amaze you actually. So the longer you are in it, a better value you can create because of power of compounding. So all the pains which you're taking in small caps is all worth it from the point of view of long-term wealth creation. That's why small cap is an exciting space for us. Govind.
Thank you, Arun. I get it as to why small caps. You have put it very articulated it very well. Please tell me, Arun, how do you go about doing the risk mitigation when it comes to investing in small caps? How have you avoided the minefields, which is anyway common in equity investing in general and in small caps in particular?
Absolutely. I think that's a good question to ask because if there is one area, one the investor has to put a lot of focus at Trustline, at least we do. This is one area where we put a lot of focus is how to build a process to avoid landmines. How to mitigate risk because small caps, all of us know that it's a very risky space, and this is where a lot of focus is put. And if you look at the process, if you in small cap investing, if you take care of few simple things, it might surprise you, but it is a fact. From our 17 years of experience, what we have figured out is if you take care of simple things, some simple things, then significant part of the risk can be taken out of the equation. Just for example, take the case of debt. If you avoid debt, surprisingly, 90% of the governance risk as well as the insolvency risk can be taken out of the equation. It may surprise you, it may look so simple, but that's what most of the misgovernance and also the corporate insolvency are rooted at leverage. And what we have figured out over the long period of investing is the lead indicator for corporate misgovernance as well as for insolvency is rooted at debt. So if you avoid debt, 90% of your risk can be taken away. Right. For example, I'll just tell you in the case in 2018, we had a lot of companies going into thin air, right? Even in larger mid caps as well as in small caps. Take the case of Z Entertainment. This was a well-governed company till 2018. In the bull market of 2016, 17, 18, I think the promoters got into greedy expansion into unrelated diversification using their plight shares, leveraged themselves at the promoter level, got into unrelated diversification to real estate and infrastructure projects. That has brought the entire Z Group down. Now, until this bull market, I think Z Group had a well-governed structure. Their corporate governance, no one suspected. But what happened in this cycle, because they got into leverage, because they got into unrelated diversification, because they got into trouble, they were forced to practice certain misgovernance, like intercorporate deposits they'd never done before. But in this cycle, because the debt forced them to do such things, which finally led to their eventual fall. Same is the case with Eveready. And if this can happen to larger mid caps, one can imagine what could happen to small and micro caps. There are many, many examples in 2018. You take 1%, you take Talwalkar, Cox and King, Syntex, and you can go on. So many companies just eventually went down because of their leverage in their balance sheet or leverage at the promoter group level. So, this is simple. If you avoid debt, of course, you can avoid all the balance sheet risk. But this is not, though it is very simple, it's not easy to practice. This is where the greed comes in. In a bull market, leverage gives you the additional kicker. So, there is a lot of incentive in a bull market to dilute your standards on debt. So it's easy to dilute your standards and chase returns in a bull market. So the skill, the discipline one can religiously practice to avoid debt in a bull market is the biggest skill for any investor. So that is one thing. So in addition to debt, I think there are simple factors like one can look at, promoters, the long operating history. These are other filters which we use to build a process to avoid minefield in small caps. In terms of long operating history of promoters, whether promoters, they stick to knitting, whether they stick to what their core competency is, they don't get into unrelated diversifications, and how's their promoter, insider compensation, and how's their related party transactions, what kind of volumes vis-a-vis their relative to their top line they do in terms of related party transactions. See, these are signals one can look at and build a process to avoid landmines. So as a result, I would say in summary, I think building a huge and robust due diligence process is very key to avoid landmines and convert small caps into gold mines. That's what I would say. And that's why this space is so interesting and exciting for investors like us.
That's excellent, Arun. I think the exhaustiveness of the process comes through the way you explained it. Thank you. Thank you, Arun, for patiently answering a few of the pressing questions, which I'm sure will be in the minds of the investors. We hope investors will find this session, both interesting and informative. We look forward to having more such interactions. Thank you and happy value investing.
Thank you. Thanks a lot, Govind, for an excellent interview. Thank you.
Thank you.
Thank you.